Hello and welcome to this weekend edition of Market the Fear Factor Taking Stock, the show where we take stock of the last week, which was one of the most treacherous weeks for our market in recent memory. There's hope that the next week could be better, and there's again that hope that maybe bottom is down the corner. I'm Anuj and with me is Lata. Hi Lata, good morning.
Good morning, Anuj. Well, first the good news. The world is a more treacherous place than we are, and let me start straight away with that kind of data. If you looked at the numbers across the world, Europe is quite clearly the biggest casualty. I mean year to date, just to iron out all the ups and downs. ATEX, Italy, for instance, have fallen between 23 and 25%. And then when you come down to Shanghai and Nikkei, the fall is about 21 to 23%. And then go far west, the developed economies, Nasdaq is down 13%, the CAC and DAX are down about 14-15%. So between the two sides of the Atlantic, the developed countries, Germany and the US, the fall is between 14 and 15%. Even the S&P 500 is, okay, much less than the Nasdaq, but even that is down about 9-10%. So where do we figure? We figure along with those developed economies, a loss of about 12%. Yes, there are the more performing markets like Taiwan, Korea, Philippines, Indonesia, where the fall is between 5 and 2%. The point I'm trying to make is that while we may wallow in the sorrow of our own earnings, and especially the PSU Bank NPLs, this is quite clearly a global risk of a fear of recession and question marks over central bank performance.
Yes, and in that my big worry is this 2008. That's been my worry in fact for the last 3 or 4 months, Lata, you'll remember that. And the headlines are now looking so eerily similar to what happened in 2008. The January-February market performance is so similar to what happened in 2008. And if you go by the kind of sentiment that we have right now, there's hope that with the kind of move that we had in US market on Friday, the collapse in volatility, maybe the market is making a bit of a bottom, especially for our market, the way we rallied 120 points. But the big worry is, has the texture of the market totally changed? It's from being a buy on dips market to a sell on rally market, and is this market going to seek much lower level from here on as well? The only the only reason the market could have any kind of rally from here on would be any kind of profit booking by bears, because this market is not going to get any positive trigger in the near term. That positive trigger is clearly out of the way. Earnings have not picked up, as we have seen, and we are unlikely to see too many moves in the budget as well. At least that's the sense that you get when you talk to a lot of people. And the biggest factor is volatility. It dropped a bit on Friday, but volatility is not a friend of bulls, and the way VIX has surged is indicating something.
Okay. I'll just go back to the global theme. Since you brought the comparison with 2008, in both cases, it is the delta which is being questioned. The world was growing at 5% up until 2007. 2008 was probably 3%. And then it could very clearly see that it is going to be deflation. So it was going from 3% to 0% or minus 1%. So it was the delta which the world was adjusting to. Today, the world is seen growing at 3%, and probably because of the emerging market fears, it will go at 2%. So again, it is the delta we are adjusting to, but the delta is nowhere as sharp as it was in 2008, so I yet have hope. And then we have one remedy which was tested, it didn't quite work, quantitative easing. So, there is always that fallback remedy which central bankers can resort to. Equally, for both reasons, I think the 2016 fall should not be as drastic, as long-winding, as killing and treacherous as the 2008. But the two of us are not experts on that area. So let's just take it to Indian markets and how we are headed and introduce our experts today. We are joined by a band of experts, despite the fact that it is a Saturday. Prakash Devan is with us in the studio, as is Vaibhav Sanghvi, the Managing Director at Ambit Investment Advisory. And joining us from Kolkata, again going all the way to the studio, is Rajat Bose, our chart expert. Gentlemen, thank you very much for joining us today on this weekend show. Well, let me start with you, Prakash. What is the sense you're getting? You've been a veteran of these cycles before. Are you getting a sense the capitulation is over, or do you think, like Anuj, some minor trading bounce we have seen and further downsides await us?
So let me first distinguish between hope and expectation, because you always hope that the capitulation is over and we've probably seen the bottom or close to the bottom. But just to kind of add to Anuj's point, anecdotally, It's eerie, but 11th February 2008, we actually fell about 837 points. And this February again, the same date, 11th, we fell about 800 plus. So, this is actually quite getting uncanny. But the reason why I'm in the camp which believes that this is not a repeat of 2008 in the same pattern, but the cut could probably be deeper because we started from higher levels. But the cut is going to be spread across 2 or 3 tranches. It's not going to be one swoosh that will bring you down to 6,200 or 5,800 or whatever people are talking about. My sense is we could probably see things looking up quite well for at least till about April, May. And then you'll probably see, the damage that's happening to commodity producers and especially over-leveraged companies in that space is going to converge or is going to peak out, and especially companies in Brazil and nations like Brazil and all. And you could probably see capitulation happen at that stage, which could be again June, July could be as ugly or uglier than this. Okay. So I don't think there's respite which is taking this away, but there's just a temporary reprieve of sorts which you could expect from this bounce back. Okay. And that's at the 68, 6,900 levels that you could see.
You say that we are at higher levels now than we were in 2008. In 2008, we were at a 17, 18, 20 time market, not stocks.
No, I'm talking about the indices.
Now, individual stocks may be, at 35 and 40 where they don't deserve to be. But as an index, we are closer to 15, 16. So, on a valuation argument, should we see so much of a fall?
No, absolutely not. So, in the most bearish of times, you are at the 10 to 12 band, and that means that we could probably lose a little bit more. But having said that, I'm talking about again, from this 9,100, we've lost a significant amount. The fall seemed much more treacherous. But, it's difficult to anticipate global factors because there's so much happening overnight. But the central bank armory this time is slightly different and more prepared. That's only, saving grace of sorts that you have.
Okay, Vaibhav, what's your call? Do you think this is just a correction, maybe a deeper correction than we first thought? And is this actually presenting buying opportunity? Or is this the market's way of telling you that, look, there's more to go, better to stay out and enter when, when things settle down?
Yeah, I'm of the view that the thing which you mentioned on the later part is something which we are thinking about, in the sense that let's on a holistic basis assess what are the factors and why the market has fallen. One, China. Is the worry over? No. Oil, is the worry over? I don't think so. These are all technical bounces which is probably happening in the market. In spite of continuous QE from 2008 till date, what we are seeing is global markets are still striving for growth. They are fighting the growth. And now about 5 countries now into negative interest rate regime. Things are not looking as good as, it may appear. Whereas Indian markets are probably, better placed in terms of the economic performance, but that might not translate into a market performance as such. So we'll have to wait and watch, see where the global things stabilize, and see how the investors take it from there.
Okay, Rajat, technically, on Friday you said that it's time to go out and be brave and buy contract. You even suggested buying stocks like ICICI Bank. Would you continue that theme on Monday morning? And would you believe that next week could be a really good week for the bulls, if nothing, purely on short covering?
Well, I for one tend to think that we have had a short-term bottom yesterday, and the kind of movement that we saw in the later part of the day that suggested that a long-tailed hammer line at the bottom. And if I could have sent you the chart diagrams, then you would have seen that they are actually, both the Bank Nifty and the Nifty have risen from significant support levels. Say 6870 to about 6800 is a significant support area. Similarly, the levels just below 14,000 is also a significant support area for the Bank Nifty. Well, I'm not saying that this is the final bottom. Even much earlier, I have said that I'm expecting the final bottom for this bear market to happen in the month of May, and that would be lower than the current levels. It could be much lower, in fact. The point here is that the kind of chart pattern that I have seen in Bank Nifty and the Nifty have been repeated in many of the Nifty stocks as well as the next Nifty index stocks, and also in a number of mid-cap stocks. These actually suggest that at least for the time being, you would see a corrective rally. And what would be the time duration I'm expecting for this corrective rally? It could be 3 to 5 days, and after that, maybe the downtrend will resume. Or because this is a special situation now, that is the budget is round the corner, it could be a pre-budget rally lasting for any number of days. That depends on market sentiment as well as international cues like that. What I'm not really worried whether you should be buying on Monday or buying on Tuesday. I'm expecting the market to actually scale up to something like 7,200 kind of levels. But what I'm really worried is that certain very bad pointers are available now. 1992, we saw the Sensex dipping 56%, 2000, 58%, 2008, it was more than 60%. So the extent of fall, we cannot really envisage. But only thing that is favoring us is that if you take that 31st Jan was the top of this bull market last year, and we are already in the 13th month. So in India, the bear market generally lasts for 14 to 16 months. So that's why in the month of May it should be over. That's the kind of scenario that is worrying me much more than that. But I continue to maintain my buy calls that I gave yesterday on Friday.
Okay. Rajat, Vaibhav, Prakash, we'll just get into a break and then discuss more immediate strategies that may be useful for both investors and traders. Back in a week, let's just present you some opinion we heard through the week.
It is not the humongous amount of selling which is actually getting this market down, but it is absence of buying, which is what is the real problem is. This is not selling. This is short selling. This is shorting. And when this kind of market happens, you can clearly see that this is investors' delight. So you have to, if you don't put money now, when will you put money?
My view has been that this whole pain is global macro and India micro, because it's not just global macro. Like, some people keep saying India is a very stable place in a relatively very turmoil world. But if that were the case, India would not be one of the worst performing markets among emerging markets. Like if we see year to date, India has not done well even in a relative context. And part of it comes down to the fact that one is India has been a very overowned market. And so, we've seen people take money off. And the other part is earnings are just not recovering.
I don't think it's a bottom yet. I think it might be a short-term bottom of sorts. Even globally, it could well be that, might see, some degree of a snapback rally. So I think the risk is, to be short at these levels rather than to be long at these levels, at least from a purely tactical perspective. On a longer term basis, I think markets are headed a lot lower, but they will not keep going down the way they have been going down for the entire month of January and February so far. There will be periodic snapback rallies that can be quite fruitful as well, as long as you can get them right. They're hard to get right, but if you get them right, you'll make some good money. But by and large, the direction that I see the markets headed are definitely towards the lower end rather than the higher end.
My fear is we'll bump along at this sort of miserable level for some time to come. Focus has perpetually been capital preservation. Our view to our clients is you're better off being conservative with your money rather than speculating. And my view certainly today remains no point jumping into the market with all your feet. There's no great reason for me to believe that there's a near-term profit to be made in this market.
And if the panic is so much that we can't hold the 21,300 and 22,500 area, then we may have further panic, and then October 8 like situation can happen, and we can have certain lower levels, which can be extremely damaging in terms of not only price but in terms of time also. If these levels can't hold, which I just explained in the beginning, 21,300 to 22,500, then based on this 8-year cycle, we may be opening a downside, extreme panicky kind of situation, reaching 15,000 levels.